Hello and welcome to this week's special instalment of Nucleus Investment Insights. Well, we are just over halfway through the week and we are already besieged with a cavalcade of news that could dramatically impact the investment world. It would be remiss of me not to start with the fiercely contested US election, in which vote counting is currently underway and is tipped not to be fully decided for some time due to the record numbers of early votes cast both in person and by mail due to the coronavirus pandemic. On Tuesday, we had the Reserve Bank of Australia announce a key interest rate cut to an unprecedented 0.1% in conjunction with a $100 billion government bond buying program over the next 6 months, as it strengthens its resolve to rescue the Australian economy from its first recession in almost 30 years. And this morning, news has come out that China has ordered traders to stop purchasing at least 7 categories of Australian commodities, including coal, barley, copper ore and concentrate, sugar, timber, wine and lobster, ratcheting up tensions in its key trading partner, of course, us, in its most sweeping retaliation yet. Here to pull apart these massive topics and to give our thoughts on the investment opportunities ahead, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Jim.
And also joining us today, of course, we have our Chief Strategist, David Llewellyn-Smith. G'day to you, David.
Hello, Jim.
Welcome back on. And just a quick reminder that before we get started, to subscribe on YouTube and click on the notification bell to be notified of when we go live or have a new webinar to watch. And follow us on your preferred podcast platform. And if you like, feel free to click on the like button on the video now to help our show grow. And for those listening in live, feel free, of course, to drop in your questions in the chat box at the YouTube comments box to have them answered along the way. So let's jump into the agenda for today. So we're going to kick off with the RBA. We've got here the RBA running up the white flag. We'll then look over to China, as I mentioned, and decoupling from Australia from a trade sense anyway. And then we'll obviously have, over that time, some more information coming through from the US election, which is currently in process of being counted. And then, of course, wrapping it all up, as we do, in our investment outlook and how we incorporate these very big themes in the portfolios here at Nucleus Wealth and the MB Fund. So to get us started... Sorry.
So you're right, Tim. I probably should say something really quickly on the US election, though.
Yep.
Just for anyone who's sort of that's the reason they're here first. I mean, I think the most obvious thing at the moment that's coming out at the moment is it's not been a blue wave. So I think that there was a question mark over whether, certainly with the polling, whether you'd see a whole bunch of states starting to fall, and it's clear that's not happening. But the second part is it looks as if it's going to be it won't be today that we know who the winner is, and for us it's sort of coming down to a few key states. But we'll go into more detail on that later, and hopefully by then we'll have a little bit more detail. But it's I guess that the major outcome is certainly hasn't been a blue wave that some suspected might be out there, and in fact the polling was suggesting in places like Florida or North Carolina or places like that the Democrats might be a chance, whereas it's pretty certain that that's not happening.
That sounds ominous. Okay, now looking forward to that at the tail end of the show when we know a little bit more. But we will kick off with the RBA. So, David, interesting news from the RBA yesterday. Now, fairly expected, but at the same time, never to be seen before in Australian history from memory.
If by that you mean sensible monetary policy.
I'll take that as a layup. Yep.
It hasn't been seen for decades, but we're seeing it now, 10 years too late. The RBA ran up the white flag. By that we mean it finally capitulated to unconventional policy, having run out of conventional. As you mentioned, the cash rate's now at 0.1%, 10 basis points. Which obviously leaves it effectively zero. So that tool is obsolete for the RBA. So what it also did,
and the other thing is that 3 year. I've put the 3, but what that means is the 3 year bond rate, which is the term funding facility, which is the key one we're watching anyway going forward from here.
Yes, that's right. The term funding facility, or TFF, is basically now the new cash rate. It's the rate at which the RBA charges, basically giving money to the banks, buying their bonds or internal securitisations, etc. And so it's how the RBA is basically disconnecting the banks from private funding rates and connecting it to their printing money for free rates, which obviously increases bank margins and lets them cut mortgage rates if they can be persuaded to do so, of course. So that's the rate that in future we think will go actually negative, but we're not there yet. So what the RBA announced yesterday was to cut everything to that 10 basis point rate, and the other major component was to introduce $100 billion in quantitative easing in secondary bond markets, targeting 5 and 10 year maturities. So that means it's yield curve control, which is at the short end. 3-year mortgages is now going to push further out the curve and aim to keep the rates on long-term borrowing rates for governments low. It will be doing this both for the federal government and for state governments. So it's clearly targeting, a form. It's not strictly speaking modern monetary policy. In fact, it argues that it's not that. In fact, the RBA itself is arguing explicitly that it's not funding the government at all, which is rubbish. But it's clearly very concerned by the growth outlook. I think quite sensibly so. The budget that we've just seen was far more austere than just about anyone recognised, except perhaps the RBA, who noted explicitly when they made these changes that they had seen the budget when they didn't need to say that. And we've seen today some of the fruits of that austere budget coming through with what appears to be an outright crash in SME employment, in payrolls data, the ABC, and the ABS. And when I say outright crash, I mean the same scale of crash as we saw when the economy was locked down.
So we've got that's a chart actually on the next page there, Tim.
Yeah, sure. Jump across to that one.
So basically, the RBA has been pushed into this position by a very silly budget that didn't stimulate enough, has torn a big demand hole in the economy, and we are starting to see that in the employment market already, and we've got another 3 or 4 months of this austerity unwind to go, and so we're going to see unemployment spike.
And just to be clear, it's not that we thought the amount was the wrong amount, we just thought it was pointed in the wrong direction.
Absolutely, it was ill-targeted.
Yeah, so the idea is that what we would have wanted to see is more support for people, not sort of poorer people who will get out and spend the money, and less for and not giving tax cuts away to richer people. So basically, there was a reverse where we went take rich people, give them a tax cut, and take the poor people who have lost their job or on JobKeeper and JobSeeker and cut what they're getting. And then the second, and then the second part is all this stuff about saying, let's try and push and get companies out to go and spend more money on capital expenditure, which is basically, because Australia doesn't make very much at all, means go and spend this money overseas and buy equipment and use it to bring back and replace employees in Australia.
Exactly right. And so that's what I mean when I say it ripped a big demand hole in the economy, and SME employment is falling into it as we speak, and it's going to get considerably worse. So I'm all for what the RBA has just done. It's just 10 years too late. It will, in terms of on balance over time, weigh on the Australian dollar. It will be lower than it would have been alternatively. That doesn't mean that it will necessarily fall. That obviously depends on any number of different factors, but it will be lower. Mortgage rates, can be pushed down by the TFF, as we've discussed in recent weeks, even further. I still don't think we're going to see a big housing takeoff in the southeastern cities, but we're clearly going to see some kind of heating up in the other states that are virus-free. So the RBA is very concerned. It's done the right thing. The other thing that I would guess we should tip into in terms of this presentation, which is also, I think, critical to the RBA's thinking, is that clearly Australia is entering a very dramatic decoupling from China. And I think the concern over the Australian dollar is becomes a great deal when that kind of political impasse is reached with your major trading partner. So the RBA has gone all in, but those who are arguing that it's out of ammunition are wrong. It can go in much further still. It could get mortgage rates lower.
So it hasn't gone all in then, Dave?
Well, it's gone in all in.
It's a big bet.
No, in the sense that it's finally pulled out the unconventional bazooka.
Right? Yeah, that's right. It's all the chips it's got on the table. It's moved into the middle, but it can still go to the ATM and go and get some more out.
Absolutely.
To the money printer.
There's a lot more it can do, and I think we'll do it over the subsequent years. But we finally made the critical jump from conventional to unconventional monetary policy, and that's massively in favour of the national interest. So hooray for the RBA. Only 10 years late, we've got there in the end. So that brings us to subject 2 of this agenda, and
sorry, Dave. Just before we jump across, I just had a couple of questions that jumped to mind. So one is you mentioned there. I just was reading about how they're focusing on federal government debt, but are actually buying state debt. I think I saw a figure of about 80-20. I was just going to see if there was any thoughts on that. It seems quite an interesting move to shift away from federal and also look at picking up some state debt.
Well, I think that's sensible in a political economy equity terms. I mean, at the moment they're printing money for banks, for instance, private entities, to make, to boost their margins. I don't think it's entirely cool to do that and leave, some of the public entities short of cash.
Yeah. That was the case where the banks were able to lend from the RBA at 0.25% on the 3-year rate, but if you were the New South Wales state government, you had to go out and lend at a higher rate.
Exactly.
Going,
the other thing is the RBA is well aware of what it's dealing with. Again, in the what is a pretty nutty federal government in terms of economic ideology and their difficulty with grasping Keynesian economics. And by that, I mean that they want to run austere budgets when the private sector is retrenching, which is a really bad idea. The RBA knows this, and so they want to get state government spending as an offset for the federal government's austerity. So, they've been quite explicit about saying they want 40 billion of investment out of the state governments into infrastructure. And I guess they just plucked that figure out of their butts, but they're getting behind it in terms of coming in and weighing on their borrowing rates as well. So they're putting their money where their mouth is. To cut a long story short. Did you have another question? What was that?
No, look, I think they got it. Yeah, no, that's fine. Yeah, we can jump across to China, decoupling. Is that where you were headed?
Yeah, so obviously I do think that one of the reasons the RBA is quite spooked is the deterioration in the Chinese trading relationship.
Sorry, Dave. I had 1 or 2 more things just on the RBA before you went further. So just in terms of actually, what does this mean for bond rates? So we saw the 5-year take a bit of a dive, and so that's certainly one area. So I'll mix in some of our investment side already. That's one area we were pretty heavily invested in, that 5-year, with the view that was where the RBA was going to have to go next. And so what we're looking at there is saying that the 10-year rate, though, and especially overnight, we saw that's really started to spike higher. So the RBA has basically come out and said it's going to spend all this money. It wants to see the Aussie dollar lower, and it's unlikely to ever go negative. We think they've probably got all 3 of those wrong. They do need the Aussie dollar lower, but the Aussie dollar actually rose, and the 10 years, even though they're out spending money on it, that actually rose, and so they're going to have to spend more. But also it's recognising that the longer term bond rates are very much tied to international markets, and so there was this idea that if Biden gets in, there's going to be all this extra stimulus, and so therefore the bond rates start. There's going to be inflation everywhere, and so bond rates need to start going up, and so that's obviously. That's something which is going to weigh. It's obviously greater that the effect of that is greater than whatever the RBA is saying. And so if the RBA really wants to get hold of that, it's going to have to do more at that longer end if it wants to. It might need to put in explicit targets like it's done with the shorter end, where it says, we're going to defend this rate, this yield rate, and the market will move there, because otherwise they'll just keep printing money until they get there. But if it's just sort of it's a little bit of just an open-ended, we'll just keep spending money on that. The longer term stuff, if they do want to get hold of it, we think they're going to have to actually be a bit more explicit. They've said they're unlikely to go negative. We don't put that much faith in that. They sort of said as well. At one stage, I thought 1.5% was about as low as they were going to go, and they've made various statements about inflation, for a long time. We do think there's that going negative is still a potential. And it's quite possible that we think the first bit is probably that you'll see the TFF go negative. So that's similar to what we've seen in Europe, where basically the TFF will be funding the banks, and just saying, okay, we will pay the banks to lend to mortgage holders. So that's
nice kickback.
Yeah. And then the final one is, and then this desire for an Aussie dollar. So yes, they spoke about their desire for an Australian dollar, and we saw Paul Keating come out with some pretty strong words on that as well overnight. That's saying, so I guess he's got similar views to David in terms of how they're looking, and to us in terms of how the RBA really hasn't been looking at the right thing. The thing is, all the other central banks have been playing for lower currencies for a while now, and so the RBA's, yes, they've entered the game, but they're going to have to do a fair bit more.
Pretty late to the party. Yeah.
Yeah, if they actually do want to see that lower.
Just quickly before we jump across to China as well. So and just maybe reflection on Europe. So if they go negative on the rates, and then so would they continue to still buy the bonds? So is it sort of something that they could do one or the other, or is it sort of something you feel they'd have to do both?
They'll keep doing both. Yeah. There'll be a whole range of it. They've already got. We haven't spoken about a number of other things that the RBA is doing. There's a whole gamut of different factors that'll be running. But I guess what we're highlighting to investors and to anyone with a mortgage is that the TFF in our view is where the action is, because that's the new overnight rate, because the overnight rate is effectively zero. And the reality is, even though you're seeing banks sort of slicing another, whatever it is, 15 basis points or so off their mortgages, those mortgage rates on overnight standard variables were much higher than the 3-year rates anyway. And so anyone who is out there looking for a lower rate isn't going to be shopping and trying to find another standard variable. They're going to be shopping looking at that 3-year rate. So the fact that that's come down to us is more important than the fact the overnight market has changed.
Okay, all right, no worries. Thanks for that. We'll jump across to China. So some big news out this morning.
Well, the last few days it's just been building, but yeah, I mean, of the top 20 Australian exports to China, half of them now are either under investigations or outright blockaded. Some of them are quite large. It's both thermal and coking coal, for instance. And basically, I mean, it appears to me this started with what we described as economic coercion, and the Australian government adopted what it described as strategic patience in response, which was waiting for China to calm down, basically, and then stop attacking the various segments of exports. But instead, China's taken one look at strategic patience and thought, well, bugger you, we'll just disappear altogether. So I think we've shifted in the last few days from economic coercion to decoupling from the Chinese side. I have no recollection of anyone ever doing this in trade to another country in the modern era, of picking out half of their exports and explicitly blocking them. I mean, this looks like the end of the Australia-China relationship to me. We can bleat all we like about grovelling over it and trying to say sorry and repair things, but this looks like a tipping point beyond which there is no return. At this point, if you go back and grovel and offer to change some of your national interest policies to reboot the relationship and trade, then if I were them, I'd just double down. Just to see how far you can push this little upstart down under. So, there are various reasons for China to go this way. Some of them are very rational.
Yep.
Over the last 3 years, Australia has been through a very intense debate and political economy process whereby we, in part, sort of quietly debated our strategic outlook and future versus, with respect to the two great powers that we find ourselves tied to, strategically the US on one hand and economically with China on the other. And that debate transpired against a background of a lot of very unfortunate goings on with Chinese influence under the radar, some of which became quite scandalous in the press. I'm not sure that we ever fully debated this as a nation, but be that as it may, there was a political decision made by the current coalition government to push back against that Chinese influence as it was seen. I think it was real, and I think it was the right thing to do. And accompanying that as well was a kind of implicit recommitment to ANZUS and the US relationship. Although a lot of this you have to read between the lines to understand its strategic force, if you like, or objective force. And as a result, I think China has spent sort of 30 years cultivating this relationship with, great, tremendous kind of trade largesse and, very deliberate kind of bribing of the Australian elite with its economic power, has realised that that's failed as a project. So, at this point you have one of their key commodity suppliers essentially throwing its lot in with its number one strategic rival, not necessarily enemy, but certainly rival. And so why would you continue to increase your intake of commodities from such a country? You wouldn't. So from the perspective simply of risk management on their part, there's no reason to continue to make Australia richer. Because you're simply increasing, the power of somebody you can't trust in a strategic sense, and then from there you can get into all sorts of tit for tat diplomacy notions. Just the simple fact that it's now a much more explicit tyranny, with all of the hard man politics that comes with that, which we see in this extraordinary diplomatic outcome of wolf warriors who just trot around the world insulting anybody who gets in their way, but with particular reference to Australia, I might add, but really throwing their weight around in ways that are entirely undiplomatic. Like, for instance, a few weeks ago, the ambassador to Canada, or a consul general, I'm not sure which one it was, a senior Chinese delegate in Canada, effectively threatened 300,000 Canadians in Hong Kong, if they don't hand over the Huawei CEO's daughter. So, China has become very hawkish itself post-COVID. You could debate why that is. I can't really think of a reason that is constructive for the world. I would surmise probably that they think that the virus is going to be with us permanently and be very difficult for everybody for a long time, and therefore their relationship with everybody is ruined anyway. And so they might as well just get on with pushing people around as best they like and can. Then you could get into cultural arguments about the children of apparatchiks who and whether they have an arrogance derived from being educated in the West, and they think that China's way is superior. Well, you could go any number of ways with it, but to me, the key point is that China basically is jack of Australia, and so I think if we were planning to do a steady or to deploy policies that would help mitigate a slow decoupling from China and look to diversify our exports over time, and et cetera, instead we're going to go through a much more accelerated and violent adjustment thrust upon us from the Chinese side. Now, that means it'll hurt a bit more than it would have if we'd managed it, but to my mind, it's inevitable and it's a good thing. We were paying a price far too high for that. For a relationship that had terrific underpinnings while China was liberalising, but once Xi Jinping took the reins and turned himself into the God King, an emperor for life, and China turned inwards much and turned much more tyrannical across all number of different measures. Then really at that point there was an ideological, cultural and political schism between Australia and China that the trade relationship simply could not be hung upon for any sustainable period. So to me it's pretty inevitable. It's just going to happen much more sharply, and obviously this is another blow to an Australian economy that's facing already a very difficult outlook.
And that's sorry, I was just going to say that's probably the issue of the day, though, isn't it? In the long run, it looks like the correct path, but in the short run, there's going to be a lot of political pain that may just see Scotty Morrison genuflect to Xi Jinping and capitulate. Do you feel?
Oh, I don't think so. No, I don't think the coalition government can afford to roll on this now. You look at any of the polling around Australian attitudes to China, they're a write-off. I mean, you get results that you don't get in polling. As I think I've mentioned before in other podcasts, the recent Lowy poll on attitudes towards China was staggering. 94% support for diversifying exports from China.
Yeah,
you don't get 94% support for the Earth being round.
Yeah. So I was going to say as well.
I mean, the bottom line is the political momentum for the coalition, especially, and since Labor has been slow off the mark on this, double especially for the coalition, is to simply follow this through, and they can't backtrack on it now. I mean, these are issues of national security, sovereignty, identity and self-respect as much as anything now. They might try and do second-track diplomacy and do a bit of groveling, behind the scenes and what have you, but I don't think that they can come back to any point where the relationship gets better. They may be able to stabilise it a little so the decoupling slows, but I can't see how they improve it from here. And I should add, this is not the end of all tradables to China. Of course not. Like, iron ore is going to be immune, but
that was an interesting exception, though, wouldn't you say?
Well, that's just simply because I think fundamentally that's probably one of the core reasons is the rest of it's happening. I mean, they hate the dependence on Australia for iron ore with good reason. It's critical. It's the critical strategic commodity for the power of the Chinese Communist Party, because if you accept the basic premise, which I think is fading this, by the way, but it's still kind of a truism that we can accept, which is that, the Chinese people have done a deal with the devil where they'll trade their freedom for a job. And as long as the CCP provides them with a sense of rising prosperity, then they won't challenge it in terms of political freedoms. If you accept that as true, then that job has increasingly over the last decade become dependent upon Chinese stimulus, and stimulus is all about building, and the building's all about steel, and the steel's all about iron ore. So that iron ore input is key input into CCP power, and I don't think they like that at all. And especially since we've become increasingly upstart, over the last 5 years, rebuffed their various attempts to influence or manipulate place, and so they're not happy with it. So the rest of it may just simply be a reflection of that dependence, but at the same time, their next round will be try to break that dependence as well, which they'll do by funding African iron ore into existence. And in the 5-year plan, there was a nice focus on increasing scrap to steel, which makes a lot of sense anyway in terms of their environmental development and sophistication, economy, etc. So they'll increase a lot of electric arc furnace output, but
also they're going to resume steel scrap imports, which they banned in 2017, and so that's retarded the development of that sector for some time, 3 years. And so with those two things, they'll try and break their dependence on Australian iron ore. And if all things are equal, their demand is probably going to peak. Oh, it's certainly going to peak in the next 5 years for steel anyway. And so you may well have declining demand in China for steel anyway, and then coupled with those extra sources of supply, then they'd be able to put a serious dent in that dependence. So that's what I think their next plan will be. That's what I would do, most certainly, and probably on the way out, try and seed some secession movements in WA and stir up a bit of civil strife in Australia, just as a farewell gift. And so, within 5 years, I would expect the Chinese decoupling to be pretty comprehensive.
And so, from an investment point of view, Damien, is this the beginning of the end for primary exporters to China that have had the rug pulled out from under them?
Yeah, I mean, it's important to note which of these are transferable to other countries and which ones aren't. So copper, for example, trades in the thousands of dollars per ton, and to ship something around the world, even if you had to send it another couple of thousand kilometers, it's only going to cost you, once it's on a boat, probably only going to cost you another $40, $50 per ton. So when it's selling for thousands of dollars per ton, say copper, just doesn't matter. And beef and stuff like that is sort of similar. The commodities, that's the whole benefit of it is China will just buy more copper from Chile, and Australia will send some across to America instead. And so that type of stuff doesn't really matter as much. Coal is a different issue because coal sells for sort of roughly that price per ton anyway. So if you need to send your coal from Australia through to Europe, for example, it's just not going to be cost competitive by the time it gets there. So there's some commodities are at risk of that. So coal and iron ore are the two big ones, whereas a lot of the other ones are just going to move to different markets. Services, wherever you can find services in there are going to cop it. But most of these anyway are all sort of generally commodity type things that will find another home somewhere else. In my opinion. So that part's not as much of an issue, but there's obviously depending upon which company you're with, there could be some serious ramifications for companies that are relying on China for.
Well, this is it, because you sort of think, well, it's obviously a pretty big opening salvo, and it may trigger something else.
Salvo, yeah. The salvos have been coming for a while. This is an extra barrage, and it's sort of a little bit hidden in the whole, I guess timing and stuff like that. Time to come in with the US election, just to sort of bit of covering fire as well to hide the fact what's going on.
Yep.
I should add that, as Damon says, most of the commodities will get shipped anyway, and there'll just be a period where they're cheaper as you try to find new markets. And I'm sure that there'll be a whole lot of shenanigans as well, where if you've got a shipload of wheat that's from Australia, then someone in Malaysia might buy it, and then it becomes Malaysian wheat, and then it heads off to China as Malaysian wheat. So there'll be all sorts of ways and means that Australian commodities will go out anyway. And in the long run, it's probably, in the long run, we should have always been preparing for the end of the iron ore boom, because that was always coming just as the developmental process of China took place. Same with the coals. And so those hits might be coming a bit earlier, but they were coming anyway. The main hit actually will probably be to services. And that's obviously the universities, Chinese migration, capital inflows,
tourism.
Like these are things that will actually have the strongest impact to domestic demand.
Yeah, and the thing is, they're not having an impact at the moment because they're already shut down. But it is an important point that's saying, well, given they've just shut down all these things, whatever it is, 9 out of the top 20 top 20 things. And actually, I can see as well that you haven't highlighted alcoholic beverages that I think they were targeting a little bit earlier, and there's probably a few others in there they were targeting earlier. But it just means that the chance of there being campaigns in China already, there are already some talking about the safety of Australian and highlighting anything racist that happens in Australia will get highlighted in China as, do you really want to send your kids there, and sort of more constraints from China's perspective about sending kids over for education, and more capital controls to try and prevent
absolutely. Yeah. So. And they can actually just block them if they really want to. Like they did do that to Korea, South Korea, I think, when it was talking about getting a US missile defense shield a few years ago. It just blocked tourism. So they do have that capability that if the numbers do start to creep back into Australia, they probably just shut it down anyway.
Okay.
Yeah. So yeah, it's more a story of how do we recover than it is to an immense being a particular blow today. Although, obviously having tradables cut off at the knees very suddenly makes it more difficult to find new markets, and the more precipitous that is, obviously, the bigger gap you will face before you get to develop alternative markets. But in the long run, it will be those service imports that will prevent a recovery.
Yep.
Okay, so should we hit the big one?
Let's head over to the election. What sites are you guys using to monitor the election for those that are watching in live, if they want to go where the pros go?
I'm watching Fox and CNN.
Yep.
Two sides of the story.
Yeah, basically.
Yeah. New York Times, I think, has got some of the best. They do some of the better analysis, and the ABC mixed with 538 as well, are quite good in terms of some of their analysis as well.
Very good. Thanks for that. I've been looking at the Bloomberg ones, not too bad either. So,
yeah.
Very good. All right. Who wants to kick off?
Yeah,
it's been a bit of a swing.
Well, I think the key thing is it's worth noting. So it's probably about so Florida, Georgia, and North Carolina were the real initial signs as to whether you'd get a blue wave or not. If they were starting to flip, then you'd go, yes, it's a blue wave. Get ready for a Biden presidency, Biden Senate, and Biden House. So the fact they haven't flipped is a sign that there's no blue wave coming. And then the other thing is these ones as well all tended to have so you basically got two different types of states in the US in terms of the way the voting's happening. Is some of them had been counting the votes before all the mail-in votes had already been counting them, and so basically the polls closed and bang, you suddenly got all the numbers came in, and those ones tended to be the Democrats tended to vote early, and so what that meant is you got this immediate blue wave where it's like, oh, Florida looks like it might turn Democratic, and then as all the actual votes came in throughout the day, or as they were counting up all the polling stations, then all of a sudden, or just gradually over the next hour, turns red. And so, so that's one type. The flip type that we haven't seen is the other way around, where they've only just started counting the mail-in votes because they weren't allowed to for legal reasons, and so that's not going to finish probably until tomorrow or the next day. And so the states are starting out red and then gradually shifting blue. And so that's sort of just knowing as you're looking through, trying to work out which are the key states. So of those, so that was the first part. The second part then is saying, well, which states really matter now? So in terms of the votes, and as you look through, if you basically make the assumption that most of the big ones that the Democrats hope they would get, they're not going to get, in terms of Florida, Texas, Georgia, North Carolina, a whole bunch of these other ones, Ohio, Iowa. And so you basically really come down to three states that's going to determine who the winner is. And so Michigan, Pennsylvania, Wisconsin, all three of those have got these systems where looks good for Trump at the moment, but you haven't started counting all these postal votes, or they've started, but they haven't. The bulk of the postal votes are still uncounted, and so you're not going to get stuff until tomorrow or the next day. And so, and in particular, Pennsylvania, which is sort of the 20 odd votes for Pennsylvania, that's really the key one behind this. But particularly if Arizona flips to the Democrats, which it might do, it's one of those ones that started blue and is going to shift red as over the next hour or two. So we'll have a better view for that. But really, it'll come down. For Trump to win, he'll need to get Pennsylvania and one of those other ones I spoke about, Michigan or Wisconsin, to make it past. And whereas Biden's obviously the opposite. So we'll come absolutely down to the wire by the look of it at the moment. So you've probably got a day or two of uncertainty. There is still the potential that Trump, he said he wasn't going to, but it is still a decent chance he'll declare victory in a couple of hours in those 3 states, because they are all looking like the Trump at the moment. But everyone knows there's lots of these blue votes to come. So he's also spoken about, Pennsylvania's got votes which they've there was some Supreme Court challenges where they basically put aside and gone, okay, which votes are allowed, and they basically their initial thing was trying to say if it's postmarked today, then it's a vote, and whereas the argument is that, well, it should be received today or whatever it is, and so they're actually putting votes aside. They're taking one chunk of votes and going, well, we're not going to count these ones yet, or we'll count them and keep them separate, and then depending upon what the Supreme Court says as to whether they include them or not. So yeah, there's going to be we're into that part of the election now. So the part I think most people were hoping would be avoided looks like it's coming. Having said that, last I saw futures, they seem to be liking it, Dave. I don't know what you're...
This is US futures for tonight's market.
Yes,
Well,
yeah.
I think US stock futures are simply up on the hope that Trump's going to win. That said, earlier on they were up on the hope of the blue wave.
Well, I think they want a result. If they get a result, they're happy.
Result,
yeah, markets want a result.
So yeah, I mean, at this stage, the worst cases, which are all the kind of paralysed outcomes, they're all very live.
Absolutely.
I mean, the so-called blue wall in the Midwest is all red at the moment. That's the Midwest kind of Rust Belt, Pennsylvania and Wisconsin, etc., etc. They're all red at the moment, but as Damo says, that was expected as the red mirage, as it was called, because they haven't counted their postal votes. They count them last. So they're all going to tighten, and they'll decide the election, and the Senate's completely up in the air still as well. So, I mean, betting markets have swung quite strongly to Trump, which I guess if you're just looking at prima facie data, it makes sense. And you have to make the assumption that postal votes are going to swing very strongly to the Dems for them to get up in the Midwest. And because Trump actually ended up giving Biden a flogging in Ohio, that's an indicator for Midwest sentiment's not very good for the Dems. So markets are probably right to be tilting towards Trump. I mean, good Lord. I mean, we can get it at this point. We could get any outcome. We get a red wave, a blue wave, or a red and blue mix going either way.
Well, yeah, but let's be clear that it's not going to be a Republican House. That's not happening.
Oh no, of course, no, that's right.
So the best Trump could hope for is for Trump to get back in and a Trump Senate.
And Trump Senate, yeah.
Which leaves us back to where we are now. I'm pretty sure there'll be stimulus coming, but it's not going to be, it's not going to be that big. I'd be guessing they'd probably be getting closer to Trump's stimulus. But again, they were talking about knocking it back. The latest offer. But I guess the benefit would be, I think it would happen a lot sooner if that happens. If you get a Trump, if you get Trump in the presidency and you get a Senate, then the policy which is stuck there at the moment, will probably pass. Whereas I think if the Senate flips, but more importantly, if the presidency flips, I think there'll be a lot of stalling in that section in the Senate to basically not do anything for until Biden takes over. So you sort of get this 2 or 3 month gap where they very much need the stimulus, but and the virus is obviously running rampant, and just not getting the stimulus. And then and the second part is, it's very close, and so there's obviously going to be a lot of feelings on either side as to which party won and which one shouldn't, and so I think a big win to either party at least might leave some of the supporters a little bit more chastened in terms of less likely to feel as if their view is the right one, and if they just were a bit angry, they could have convinced some of the other side. Whereas I think if it's quite close, then it's quite possible we'll see a bit more of that. A bit more, I guess, social disruption. Let's put it that way.
Just a quick one, actually. I've just been following throughout the day on the Bloomberg data inputs here, and they've lifted their voter turnout percentages, right? So at the start it was set at a typical setting, and I've noticed in the last sort of half hour, 40 minutes, they've had to move it to a high voter turnout estimate, right? And principally because the one I was looking at was Florida, they'd counted 120 odd % of the estimated total vote, so they've had to kick it up. But the point I'm trying to make there is that it appears that this is actually a high voter turnout election, essentially, which does that indicate potential for change?
We knew that already.
Yeah,
we all knew that already. There was already I think I think Texas actually passed, just in terms of early votes, was bigger than the number of votes last time.
Wow.
So just a number of people. Yeah. So no, we look. It knew it was going to be massive in terms of the turnout, but it does look like we're going to be waiting around for Wisconsin, Michigan, Pennsylvania, your 3 ones, which are all going to look like they're Trump's, but there's going to be a late push to Democrats, and you just don't know. It's going to be down the line.
Yeah, exactly. Yeah.
They all could go either way, and one or other party picks up all 3 of them, then they've won. Actually, if you get 2 out of 3, I think, based on how the other states look like they're going at the moment, assuming Arizona falls to the Dems, then basically whoever can get 2 out of the 3 of those states will be the next president.
One interesting point at this stage, at least, they haven't added California to this, so we'll change it. But Trump's up in the popular vote by 5 points. Right?
Yeah, once you get California in, that flips.
Yeah. Flip over.
Yeah,
so.
That's I think in terms of polling, obviously the polls have missed again the Trump vote, but it's not by a dramatic amount in the ones I've been looking at. So they look pretty good in most of the states so far. Florida, they're probably going to be miss by about 2%, I think. So within that normal range. That'll be the big question, is whether is really, once you get to, for Pennsylvania, Wisconsin, and Michigan, they were all up pretty strongly before. I think the latest polls for those 3 was Michigan was 53-46 or 54-46. Wisconsin, a similar number, and Pennsylvania was 52-48. So, Pennsylvania, a 2% miss on that would put it back into line ball. Wisconsin and Michigan is going to need a considerable miss in terms of voter intentions to do that. But not to say it's not possible, but it's going to be. I need a bigger miss this time than what Hillary had. So
Okay. All right. Very good.
So what does that mean for markets?
Yeah, let's jump into the markets. Absolutely.
Yeah. Absolutely, Dave. Do you want to go first? What's your?
Well, I guess we could just do the scenario analysis. The longer it drags out, obviously, the worse it is for all markets, and you can draw your own conclusions on that. It'll be stocks down, presumably a returning bid to the bond curve, which has been selling off on the prospects of a blue wave of stimulus.
So that'd be the first problem, and then the various implications of that for emerging markets, commodities, Australian dollar, all the risk kind of assets that rise and fall depending on how bullish markets are in the US. Then beyond there, if we get the blue wave, well, I think Damo's right. I think it'll be Trump stimulus, and the virus is running amok. Europe's already shut down. The US, if it's blue wave, will go through more shutdowns, you would think. They'll be local, but because they'll get Washington support, there'll be more of them, I would think. And so more official shutdowns. That said, leading US indicators for mobility, etc., are already plunging anyway. As we've described before, there's a natural equilibrium with the virus. Death rate starts to climb, then the private sector just shuts down.
So actually, we should go into a little bit more detail on that. So for anyone who hasn't heard us talking about this, basically what we're saying is that what you see within the within communities is, regardless of whether there is an official lockdown or not, when death rates and hospitalization rates get high, people stop doing things. So what we're saying is, yes, it will make a difference as to whether you have a politician come out and say, no, everyone has to lock down and do things. But the net effect is, if you're starting to see these real spikes that we are now, you're going to see economic slowdown regardless of whether you see whether you manage to keep the economy open or not. So that's
it's going to be material. There are good reasons to think that it'll be nowhere near as bad as the first wave. One being that people have adapted better, but two, there's a big inventory cycle underway globally for manufacturing production, which is very strong. Inventories are very low, and so that's going to go on regardless. So you won't see trade or manufacturing shut down as it did in the first lockdown. So most of the impact is going to be in the service sectors, tertiary sectors of the economy. So that's already very obvious in Europe, and it will become increasingly so in the US. So in short, I guess either way, the next 3 months, 4 months is tough for the US. If it's Trump, we won't see a lot of stimulus either. If it's Biden, it'll be blocked. Then beyond that, you get the vaccine wave deeper into next year, along with either blue wave stimulus or perhaps a little bit more from Trump. And then markets are obviously keen to see the return of inflation on the basis of all this stimulus. We think that that's extremely dubious.
So probably bond rates. If it's all locked up, then it probably means that bond rates lower.
Well, we're going to see some sort of backup, I suspect, at a certain point when markets think it's inflation's coming and there'll be a tantrum, but it won't last. Because the moment you choke off any of this stimulus, it will just slump again into stagnation, even notwithstanding the virus, which is going to make it worse. So how to fathom these things for markets? It's still an environment absolutely replete with risk. You've got in the background still plenty of monetary support, which is obviously keeping stock prices high, but gee whiz, I mean, the main game these days for stimulus is fiscal. Even the monetary stuff these days, a lot of it has to be channeled via the purchase of government bonds. And so if we don't get any support coming out of the US as the economy slows, then there has to be risk again of downside for equities, even as they try to party coming out of the election. I mean, they might get a nice pop out of the election, but the virus is yet to be reckoned with. So it remains a very difficult environment. Once you've cleared up the election, you have to confront the virus.
Yep.
Yes, absolutely. And so that's the thing I'm sort of looking at. And you also have to confront bankruptcies and people actually having starting to pay interest on their mortgages again, or at much lower interest. But there's similar things happening globally.
Well, that's the thing. If you don't get the stimulus, you will get those instead. That's where it all went into that into either boosts for income or moratoriums on costs. So, yeah, it's going to be very difficult. And as we already mentioned in this cast, and which sadly we predicted after the budget, well, what we're seeing already over the last few weeks or the last month in Australian payrolls is the future of it. And that is, if that stimulus is removed, there'll be segments of business that will get absolutely smashed. You know, you've got to remember that a lot of these economies are still running at 80, 90% previous capacity. And so even though they're growing from those levels, you know, if you take the stimulus out, then the demand hole is enormous. And so you just convulse into new waves of supply rationalisation, which means more job losses and lower wages, and et cetera, et cetera. You know, so it's going to be swinging between these polarities, political and viral, for the next 6 months, and then we give the vaccine wave a shot, which is going to be very difficult, much more difficult than we think markets are pricing, but it will help.
Yeah, but so your best hope for markets, I guess, is then, David, that that they look through and say, well, there's stimulus coming in 3 or 4 months' time, and so they manage to keep markets high until then, and then you start getting these waves of bank, you know, despite the shutdowns and all that type of stuff. It's like, oh, there's more stimulus coming, and then you get through that next phase of I guess from central banks, and then you get through that next phase. Then you're sort of hoping, okay, now our next one is we're going to have vaccines coming again, and so, you know, and you sort of just, I'm sure there's other bits of hope. I had one other that's slipped my mind since I was doing it, but you know, there's, I guess, a number of things of hope you can get the market to sort of sidestep from one bit of hope to the next bit of hope, and just keep ignoring the earnings until one day they might actually come through.
We should add that Q3 earnings in the US were really good.
Yeah, so
it
relative to expectations. Yeah.
Okay. Yeah, they did snap back very well. The problem is, you know, that was okay. So they got hit by the virus demand shock, sacked everybody, readjusted their cost base, and then had one reopening quarter. But now they're going to take another top line hit, and so you might have to redo it.
Yeah, and so it does look as if US earnings for next year are going to be up. For next year are going to be higher than 2019 by sort of 4 or 5% higher. But the flip side is then the rest of the world still looks pretty dire. But I guess
I think the virus will knock that out.
Exactly. That's predicated on things still being pretty good and not having this second or third wave of the virus, depending upon where you are and how you're, or first wave, depending upon how you're counting. Yeah.
Quick one here. Mentioned before the a potential upside vaccine shock, I guess. Is there a downside to the vaccine as well, though, in the fact that it gives all these stimulus measures an opportunity to be switched off?
Well, one it's that point about saying, you know, with Biden's one, Biden's, if he gets in, you know, and if he gets in and gets the Senate, which is looking, you know, at very dicey at best, but you know, if he does, but for a while there, that was looking like the most likely scenario, and he's going to add another 10% effectively deduct another 10% off earnings just in taxes alone. But the market basically didn't care in terms of, you know, as those things were coming up, because if you don't care about earnings, then why would you care if earnings were 10% lower?
Yep.
But the question is, at some stage when they do start caring about earnings, and you never know when that is, but markets do certainly go through dislocated periods, but eventually they always come back to the fundamentals. Then you know, you've got that issue, and I guess it's that point about going, well, if listed equities are so expensive, then it starts getting to the stage where it's cheaper to start a new company than what it is to buy an existing company. Then that's where you get, you know, more and more capital flowing into the sectors and flowing into competition and you know, eventually drive some sensibility into pricing. So because at the moment though, it's very much that the prices you get for some of these things is It's extremely high, and this huge premium for growth. I mean, we were talking this morning about comparison we've been doing between advanced micro devices, AMD, which does computer chips, and Intel. So AMD's like just come out with a new and great chip, and it just looks way better. They're much smaller, but they've got momentum. Their technology looks better at this point in time, and they've certainly got some great earnings growth coming through versus the incumbent. And so based on last year's earnings, AMD trades on 90 times PE, and Intel's trading on 8 times PE on last year's earnings. So there's a certain point where you say, well, yes, I do really like AMD, it looks way better and all these other factors, but am I prepared to pay 10 times more for each dollar of earnings at the moment? And so, that's sort of like taking a very extreme point, but at some stage that starts to come back through and going, well, how much realistically should I be paying for these companies, even though they are good?
Yep, fair enough. And just, I guess, from our portfolio point of view, and just to sort of wrap up in interest of time as well, I think we've just jumped across to the investment outlook, Damien. So we're still maintaining that cautious outlook.
So we've been playing around a little bit. Well, we've been looking at a lot of our bonds, but I think there's so the RBA announcement from yesterday obviously came very much in vein of what we've been saying is going to happen, and that's why we loaded up very much in that 5-year range. So we probably will shift that around a little bit over the next couple of weeks, but we're sort of waiting for markets to to settle down or at least to give us a better opportunity in some of those in other areas. Within
it's called Arizona for Biden.
Oh, is it? Right. Okay. There's there. Well, that gives you back to those 3 states still that we're talking about. Saying
Wisconsin Wednesday, Michigan. So that's today, right? Or is that
tomorrow?
Wednesday, US time. Michigan Friday, Penn Thursday. So by the weekend we should.
But there's court challenges in some of these for how long they're taking with the votes, and there's other stuff going on as well. So it's not. It's going to be messy. Is I guess is the real answer. And yes, futures were certainly up, but I think I wouldn't be. I'd be quite nervous about trading too much into this, because there's going to be some pretty big. There's a lot of unknowns at this point of time. The clearest thing we can say is there's no clear winner. So. Sorry, what was I saying? So bonds.
Just sort of got up there, low return environment, but volatile. And I think that sort of leads exactly into what you were just saying moments ago.
Look. I don't want to sort of front run some of our own trades, but we're certainly looking at the moment. We've had a fair bit of cash for a little bit, especially as the market has sort of pulled back over the last couple of months. So we're certainly looking for opportunities, and we're hoping. A bit of volatility and a bit of uncertainty will throw up some interesting names and thoughts over the next couple of days. But we've been relatively quiet for the last week or so in terms of our own action. But certainly looking that I think there is there's certainly going to be volatility going forward over the next little while, and without front running too many of the trades we want to do, but we've got a number of different areas we've sort of circled that we're saying, here's where we want to buy. And we've been sitting on that Aussie bond trade for 6 months now. That's sort of come good over the last couple of months. And certainly, the cherry on top yesterday. So we're looking for the next. We've got a few other ideas that we want to redeploy that into.
Okay, very good. All right, gents. Well, look, thanks very much for that. And as you said, we've still got plenty to hear on the US election, and I think the China one's got a little bit to go as well. So we'll hang in hope, and probably it'll be a topic of yet another podcast. So thanks again for your thoughts. Thanks to you, Dave and Damien.
Thanks.
Thanks, Tim.
Good stuff. We'll catch you guys soon. Actually, just while we're signing off, we did have one last question. I did mean to pop it in. Got a bit caught up. AUD all over the shop, but downward trend establishing now. Just a final blast on the AUD thoughts, perhaps, David?
Sure. Look, it's all such a mess. It's difficult to know. It's clear that markets want to sell the euro. Want to sell the US dollar. No matter what happens coming out of this, they want to see vaccines as a recovery play, and they want to sell the US dollar and get into emerging markets. To cut a long story short, and that's the basic kind of cyclical thrust of where we're at. So that's obviously upward pressure on the Australian dollar. Having said that, there's a whole range of issues that mean that the Aussie is, got some very serious headwinds. Some of the biggest ones we've discussed today, which is, the RBA is piling in finally into the currency war. Then we've got the trade decoupling from China.
But
and we're going to have a really shitty recovery as well. And so,
and David, taking a big step back, basically China comes out and says, "That's it, Australia, we're done. I'm breaking up with you." The RBA says we're going to push the Australian dollar down and spend $100 billion to do so, and the Aussie dollar jumps 2 or 3%.
Look, the Aussie jumped because the US dollar plunged last night. That was more time, just unlucky timing. At the same time, it was sell the rumor and buy the fact, right? Which is classic. Because the Aussie had fallen 4 cents more or less since the RBA had said it was going to pile in. So the discount was already there, and then the rest of it's just day-to-day vol. The Aussie's been at 72 and 71.50, 70.50 today. It's all over the shop. I think probably sideways-ish for the next 6 months is the best bet, with volatility as those various tailwinds and headwinds duke it out. I don't think anymore that the kind of 80 cents forecasts that we've seen from various banks on a global recovery are realistic. I think the bull run is in trouble. And then the final key right now is iron ore prices are still very strong, but and that's got about 6 months to run. It's obviously driven by a new round of buying in China on stimulus, but it's also been because the Brazilian supply side accident, which is almost resolved and is going to pass even more so next year. But critically as well, it's iron ore restocking in China, which had been run down prior to the virus, and so that process it's going to be exhausted sometime in Q2 next year, and so then that starts to fundamentally undermine the currency as iron ore falls back to 80 and then $60 into the second half of next year. So I don't think that the Aussie can get much further above where it is now, but certainly could, just as this weak US dollar play comes through, and then certainly by the second half of next year, I'd expect the Aussie to be in quite a bit of trouble again and just be trending down. So it's fair to say that the peak might be in. I think we'll struggle to get above that again, and I just wouldn't call it a downtrend yet, but I do expect it to turn into one.
Okay, very good. Anything to add to that, Damien?
No.
Pretty happy with that one?
Yep.
Dave loves the Forex. He always loves an AUD question, so I thought we'd pop one in the end there. So thanks, gents. All right, very good. So coming up tomorrow, we're joined by innovator and technologist and friend of the show, David Morgan. David is founder and CEO of Perth-based clean energy company Iron Matrix, who are leaders in bringing environmentally sustainable, energy-positive homes to the mainstream. He's actually figured out that it's cheaper and obviously energy-positive to clad homes and buildings in solar panels instead of the usual cladding materials like brick. And he's back on the show to share his thoughts on a new boom in clean energy and why he feels that this is maybe the most profound disruption of the energy sector in over a century. And we'll also be discussing how this may mean a new dawn for Australian manufacturing and perhaps a new future for Australian employment. So no doubt he's a pioneer in the renewable space, and I can't wait to have a chat to him tomorrow. So that's Thursday, the 5th of November, 12:30 p.m. at the usual time for the live chat with David Morgan, and head over to our YouTube channel, Nucleus Investment Insights, to ask questions along the way. Well, thank you to all those who've watched in live today for another great episode, and also for our fellow who asked a question. I hope you've taken away some great ideas. If you'd like to see more of our content, head over to nucleuswealth.com/content. To stay up to date with news from us, follow us on social media. And finally, if you know anyone who would get something out of today's episode, let them know about it, share with a friend, and help our show grow. Thanks again for tuning in. From myself, Tim Fuller, and the team, and we look forward to catching you at the next one. Cheers.